What's up, folks? This is the Investor Weekly News Update for August 28th. We're going to be talking about what's going on with rents. Why is everybody moving to Texas, especially from those of you guys in California paying all those taxes? And what is going on with the beloved Subway franchises? But before we get going, I wanted to had some of these thoughts as of mine lately with a lot of our family office members got kids, and getting to that end game level for $5 million is obviously a goal, but in that time getting there, how do you pass on the wealth and then also the ideas of entrepreneurship as opposed to just working a job where you have income coming in, but how do you either turn that into an investment enterprise or become a business owner and make a much higher uncapped level of income? Entrepreneurship is like those carnival games that you see out there where you throw darts at something, where middle class kids, they can afford to throw a dart. Most miss, maybe they call it that they don't have the drive to do it because their life is pretty good and they have a dozen of those big stuffed animals at home anyway. And when a few miss, but some will hit the target and get a small prize. And a very few of those middle class kids will hit the bullseye and get a bigger prize and become rags to riches. And then, of course, the American dream lives on. Whereas rich kids can afford many dart throws. And if they want to, they can try over and over again until they hit something and feel good about themselves. Some keep going until they hit the center of the bullseye. Then they give speeches or write blog posts about meritocracy and this is what I think maybe this will happen with my kids, where I was thinking of putting somewhere in the trust where they get a semi-unlimited amount of dart throws, where literally at $50,000 or $100,000 of seed capital to go to some kind of entrepreneur venture, where somebody, my trustee, looks at it, and as long as it's not totally an idiotic idea, they get that 50, 100 grand so that they can, maybe pay for some ads or some coder, or depending on what kind of business it is. But at some point, you throw so many darts at it, and especially when you go through all these iterations of failures and you've learned things from past failed businesses, the whole idea is you tend to get better at things. And maybe by the 5th or 20th dart throw of burning up daddy's 50, 100 grand on this next business venture, maybe they've gotten better and they might actually do something well, or at least they've used all my money to, instead of just partying with cool people of high impact, they're able to get to a point where they can utilize those relationships and have to some benefit to the business. When you think about it that way, it's like, how can you not hit a home run with that? And then on the opposite end of the spectrum, man, it's the poor kids out there. They're not even visiting the carnival. They don't have the relationships. They don't go to the private schools to get access to alumni networks or be friends or go to birthday parties with these influential families and eventually influential people. They're the ones working the carnival, taking the money and giving out the darts for having other people go ahead and take a swing at it. And that's sad. I think you do see a lot of cases where it's like that poor kid rags to riches, or maybe that's just the middle class kid who gets to only afford to throw one dart at it. But I think this is why I don't really follow like Bill Gates and the Elon Musk of the world, because they were the rich kids who were able to throw a gazillion darts at the board. And I personally never had a million darts to throw at it. We started investing in 2009, and then in 2015, 16 started this whole podcast when nobody else did podcasts. And I think that's what really started the business for me. And I never really threw a dart at it per se. I just did it as a side gig, which I still think is the best way for most W-2 employees to start a business. Do it while you're working your job. If you guys want more information about that, I gave a speech at simplepassivecashflow.com/quit for you guys to learn more. But again, moving on. So apartment demand rebounds as rent growth further cools. 2023 apartment rent growth is slowing while demand is rebounding. Second quarter net absorption nearly matched new supply. And so after a huge upswing in 2021 and this kind of retraction, looks like we're getting back to a point where apartment demand is normalizing this year. Yet it struggles to keep up with the increasing supply, as there's a lot of new units coming online And you always have new units coming online, but sometimes if you think about kind of water pumping through the system, sometimes that flow, that supply is a little bit more than other times. And that one of those kind of times is right now, but should subside maybe in the next quarter or two. Apartment owners should prioritize occupancy over rents due to increased supply options, leading to lower rent growth. So that's something definitely we're looking into going into Q4 of the year, which is traditionally a slower lease up period. It's just getting heads in beds, doing what we need to do for concessions and just driving up the occupancy. Not hitting those higher level rents is seen as, yeah, it's not the season for that at this point in time, with a lot of this new supply coming online and adjusting our expectations to that. Here's a chart from RealPage of month over month change in the US apartment asking rents. You're seeing what kind of happened in pre-COVID. And then what I would do is look at the 2022 versus the 2023. The 2022 is that darker blue, and then the teal is the 23. And you can see where it is almost a third of where today asking rents is about a third of what it was in years prior to. And I really like this metric because it's a percentage off what it is currently, as opposed to some plus $200, $300, $100. It's relative in this manner. And you're also seeing the seasonality in this graph from the different months. Obviously, from you're going to have a lot more increases in the moving seasons from January through August, as opposed to September, October, November, December, which are traditionally slower months. But who knows, right? What's going to happen this year? Next article here, Californians are fleeing to Texas where homes and the cost of living are cheaper. So various reasons here. Many Californians are living in Texas due to rising costs. About 100,000 people are moved from California to Texas in 2021. Texas offers a more affordable lifestyle compared to California. I would also add maybe like 5-10% less in taxes, especially on the income tax side. Texas has a favorite income to cost ratio with lower housing prices. Median household income in Texas is $67,000 and the median home price is $362,000. And California has a higher median household at $84,000 with the median home sale almost double at $796,000. California cost of living is 39% higher than the national average. And in Dallas, this was one case, a use case. This guy bought a 2,800 square foot home for $500,000 after paying $2,400 a month for a small apartment in California. But we do talk a lot about people moving from California to Texas, especially because the income tax is a lot lower, which kind of makes more sense for the people out there who are retiring, switching over to that more tax efficient model. That said, you're going to always get paid more in those high price areas such as San Francisco and or California. And that may be what's needed when you're trying to build up that first $1 to $2 million net worth, right? You have to pay a lot of taxes to be in that high income type of area. Sure, you might be one of these lucky individuals who is able to circumvent all this by remote work, but generally speaking, you're going to be in a higher income range if you're living in these types of areas. If you guys are interested in joining our community, make sure you join at simple.com/club. But moving on, we are looking at the top US multifamily rent growth markets for Q2 2023. Reading these off: Nashville, St. Louis, Central New Jersey, Boston, Denver, New York Metro, San Jose, Dallas, Houston, New Jersey, Fort Lauderdale, Seattle. So I think what you're seeing here is a lot of the bounce back. I'm seeing a lot of Boston, New York, San Jose, Northern New Jersey. A lot of these were the ones that were beaten up 2020 with the pandemic, and you're seeing a lot of this demand coming back. I'm trying to look down this list. I don't see any Boise, which everybody thought was going to be the best market ever in 2022. And now we're seeing a little bit bounce back to the normals. With some of these, if I'm looking at this list, the Nashvilles, the St. Louis's, the Denver, the Dallas, the Houstons, Fort Lauderdale are those ones I would key on more. This is moving back away from the Sunbelt dominance as it once was, but I still think the Sunbelt dominance is still in effect. This is just a little bit of the bounce back from the trough for 2020 for a lot of these markets, namely the New York and the the Northeast kind of corridor. Average effective rates increased by 3.8%, a decrease from the rapid rate pace in 2022, which was 10%, 2021, which was 12.8%. And then finally here, a little bit of fun thing here, says Subway. If you're like myself, you're probably tired of Subway. I must have ate Subway like 200 times from like 2000 and then, or every year from like 2010 to 2013 when I used to work on the road. And the only thing that was available to me was Subway. So I'm going through a little bit of Subway withdrawal even a decade later. But Subway is seen as, back then, there was a big private equity push to get Subway all the way out there. And now there's a little bit of brand fatigue, obviously. The big thing with Subway is these guys don't change their menu, or they try to, but it's the same damn thing. A private equity company, Rourke Capital, offered almost $10 billion to buy the company. They manages $37 billion in assets, and they specialize in franchise and multi-location businesses. So it lines up well with their prospectus. So this is the first time Subway depart from family ownership. And that kind of makes sense, right? Because I think a lot of people have been hearing Subway's been struggling and it's like time for them to maybe cash out. Maybe if you look at it from like an investor point of view, you've got that cash flow in the meantime, you saw it grow a bit, and now it's time to take it to pastures and get it to another company who specializes on this type of operation, or maybe see some kind of avenue to value add the franchise from here. Who knows? So maybe you might see some fresh ideas from coming from Subway. And I personally don't think I'll be going back, but who knows, right? Or maybe I'm an untapped customer. If you guys are interested in the podcast, check us out. We are going to be rebranding to the Wealth Elevator here very shortly. So Simple Passive Cash Flow will be going away. And this is all in advance of the new book, which is getting to be over 200 pages. But if you guys don't have much time and you guys want to do a quick read, just go and check out my first book. I think most people say they knock it out in 3 hours, but The Journey to Simple Passive Cash Flow found on iTunes. And then if you guys want to check out the free audiobook version, you can go to simple.com/book. And we'll see you guys next week. Bye.